Welcome back to the 2022 Digital Health Day and the HITLAB Innovators Summit. As you can see, we have a tremendous agenda stacked up for this afternoon, and we're excited to lead that off. And these discussions around digital transformation and making sense of digital health and its growth by presenting and by hosting and welcoming one of our favorite professors, tenured, permanent at Columbia Business School, Professor Rajgopal, who will talk about from an outsider standpoint, since he's not from healthcare per se, but a brilliant mind, brilliant economist, and he'll present some outside thoughts on what we can do to make healthcare better. Professor.
Thank you. Thank you. And I know I've been slaughtered with the dreaded post-lunch session. I'll keep it short, just 15 minutes. So what am I going to do? So I'm going to talk about this company called Teladoc. I'm sure most of you know about this company. And the idea is just take a look at their valuations, maybe stress test their business model, if you will, with fundamentals, and maybe leave a few ideas on what to look for and where might this company be going. So let's start with, maybe we should just go back a little bit. Look at that stock price roller coaster, right? I mean, this was pretty common. Most companies kind of crested around, early 2021, partly because interest rates were low. When interest rates are low, discount rates are low, so valuations go up. And then, of course, things have fallen by roughly 90-odd%. So the market cap for Teladoc was roughly $4.5 billion or so when I was putting this together a couple of days back. Revenue of $2 billion. And of course, they make GAAP losses, minus $0.43 billion. And I usually like to start with the balance sheet. I'm sure lots of numbers here. People kind of maybe, if your eyes are glazing over, the way to read these balance sheets is to usually start at the bottom and then go and try and understand a couple of big numbers, right? That's what I do. So 17 billion roughly of assets. And as you can see, most of that happens to be goodwill and intangibles. What does that mean? That usually means these things have been acquired through, either an acquisition that was paid for through cash or paid for through stock. If you take those two assets out, there's not a whole lot, at least in terms of conventional assets. Now, one of the claims I want to make here is that at least 75% of that, I think, has probably gone up in smoke. And I'll try to justify what I mean by that. So let's now flip over and maybe look at the liability side. This is the liability side, not a lot in terms of liabilities, a fairly big shareholder equity number, which is mostly, as we discussed, supported by those two intangible assets, right? And if you dig deeper, again, I try and understand one or two big deals that the company entered into. So as you probably know, the two big acquisitions they made, a company called Livongo and a company called InTouch. So let's look at Livongo, for instance. They paid roughly $13.8 billion, some of it through cash, some of it through stock. This disclosure tells you what they paid for. And it turns out 12.79 of that is quote unquote goodwill. And there's some client relationships which they paid roughly $1 billion for. And you see a similar version of that deal for InTouch. So, you do some simple elementary math. Teladoc trades at 4.4 bill, revenue of roughly 2 bill. So let's say 2.1x. You apply 2.1x to the Livongo and the InTouch payments that we made. That effectively means roughly 12.5 odd billion of goodwill and intangibles probably have lost value. So it turns out in the third quarter of 2022, in this year, they've roughly written off about 9.6. So this tells you that at least around 3 bill odd probably needs to be written off as they go through this exercise. So what's the big idea here? I mean, the goodwill write-downs are fine, but the question is, when we make these acquisitions, how much are we paying for these customers? Are we hooked to making acquisitions to keep reporting revenue increases? That's the other thing to worry about. And that's what I turn to next. So this is their income statement. Revenue has gone up roughly by $938 million. We'll come back and talk about costs in a bit. And one of the guiding principles that I propose is very simple, elementary economics. But as you know, sometimes common sense is not common. So just break revenue down into quantity, price, currency. Break costs down into fixed costs, meaning costs that don't change a whole lot given a certain range of volume, plus the so-called variable costs, which would mean that, if there's more activity, more volume, you have more costs. It's like elementary stuff. Having said that, figuring this out from the financial statements is not that elementary. It's actually quite complicated, partly because disclosures are not all that great. So let's start with revenue. So if you look at, say, revenue increases here, Teladoc reports two types of revenue: access revenue and visits revenue. And again, you guys are the experts, so I'm just going to propose a few hypotheses. If you think I'm out to lunch, tell me. It's good to know. So the access revenue, what's going on with that? 1.7 bill of access revenue, roughly. Revenue went up by around 810 mil. The visit revenue is up by about 30 mil. So my understanding is that this is something like the Netflix model, where you're basically selling subscriptions, and then you're also billing people when they actually come to visit your clinic or some kind of physical facility. So let's try and understand, why were they able to report 810 as revenue? So these are excerpts from the financial statements that you don't have to worry about as much. I'll just cut to the chase. So I tried constructing a simple model. It looks like they have 53.6 million members. They charge roughly $232 per month times 12. So I'm able to reconstruct the US revenue. When I tried signing up to this service, it looks like the retail membership is quite high. It's like roughly around $100 a year. So I was not able to make sense of what's going on. If the retail price is 100, why is the company only booking roughly $2.32 per month, which is roughly like $30 in annual revenue? So that's something I don't quite get. Maybe there's something else going on here. But what am I looking for? The classic idea, right? How much more can you report as revenue by either squeezing out incremental fees versus adding quantity of members? It turns out, as you can imagine, a small increase in the fee, which went up from $1.12 to $2.32, explains most of the revenue increase, because a small increase on a large base is a lot of money. And how much of this revenue increase was explained by quantity? That's relatively small. 1.8 million new customers, $232 per month, time 12 months, roughly 50 million. So what's the takeaway here? The obvious question being, how much more can you squeeze out in terms of revenue increases, right? Given competition. And revenue increases are a far more efficient way to add revenue than going and finding new customers. So they've acquired 1.8 million customers last year. If you go and look at the rate of acquisition, that's kind of falling over time, which goes back to my earlier point about Livengo and the others. If you go and buy companies, it's fantastic, except you're paying a big price to buy those companies. So how much is your organic growth versus how much is your acquired growth? More important, what kind of price are we paying for the acquired growth? Because all these goodwill and intangible write-downs, all that is too esoteric. Only the accountants kind of understand that. But in terms of plain economics, it simply means we paid a lot of money to acquire one customer. And more important, are we hooked to acquisitions to be able to report revenue growth, as opposed to maybe able to grow revenue organically. So I repeat this exercise with the visit business. Here, things get a bit opaque. I didn't quite, at least I don't feel super comfortable with what I've come up with. So they have, 15.4 million visits. They reported around 254 million in visit revenue, which tells me that the average revenue per visit is roughly $16.50. When I repeat this for changes for the year, the average revenue seems to have fallen to around 7, which simply perhaps means post-COVID, people are visiting clinics much more than they used to before. So the visit revenue, by and large, seems to be a bit of a wash with the visit costs. So the way to effectively book more revenue seems to be a price increase. The question is, how viable is that? Now let's take a quick look at the costs. Again, separating fixed and variable costs is incredibly difficult. And you look at the rate of growth of costs, that's kind of going up astronomically. Advertising is up 84%, sales costs are up 63%, tech is up around 89%. So most of these companies usually sell the story that they are scale businesses. So what does a scale business mean? It's elementary economics. You spend a bunch of fixed cost, and at some point, you've created enough quote unquote network effects or tipping point or scale or whatever fancy word you want to use. And then the incremental unit that you sell is mostly contribution margin that goes into profits, meaning it's very profitable, right? I frankly haven't really seen that textbook model work well, except for maybe Facebook or something like that. But Facebook, of course, got into trouble for unrelated reasons. So what am I looking for? I'm looking for two things. Have these fixed costs somewhat stabilized, right? And are we seeing the so-called tipping point, or the idea being that if I increase sales, most of that ends up becoming profit? That's what I'm trying to look for before I try to take you into the data. So what do I see? Again, a lot of this is quite opaque. I mean, I was trying to do something very simple. Look for unit economics. How much does a member cost me? How much does a visit cost me? It was fairly hard to figure that out. But without dragging you through the details, what I came up with was the costs of a visit roughly work out to $10 a visit. The revenue worked out to roughly 16 odd a visit. Maybe there is some money being made through visits, but most of it is being made through membership. So what does it take to acquire these members? So if you go through some simple math here, I came up with roughly $1.4 odd billion of fixed costs. So that roughly tells you something about break even, right? At the very minimum, you want to pay for these fixed costs. And in my definition of fixed costs, I haven't included things like intangibles and so on. This is before tax, before capacity costs. In terms of just fixed operating costs, am I able to break even, right? So that's what I'm trying to do here. And then you can back out and work out how many more customers do you need to be able to pay for this. The other way to triangulate this data, take the stock price. So the stock price was roughly $29 a share, 166 million shares. That's how we roughly get our $4.8 billion of market cap. They have no earnings. If they did, I'd talk about that, but all this is future growth. So what does that mean for me as a CFO or as an investor? I need an EPS of roughly 3.19 per share, which multiplied by 166 million shares means I need to make $529 odd million in recurring earnings, not revenue minus cost, right? Then this becomes a little more understandable. Why? Because I have a membership base of roughly 54 million members, which means, again, common sense, I need to be able to extract $10 in post-tax income every year to be able to even justify my 4 billion valuation, which remember is roughly 5% of what it was at the peak, right? So again, a lot of this is plain common sense. I need to either increase members, or I need to squeeze more price increases from the members, or I need to cut costs. These are the only three ways in which business works. But at least it gives you a sense for the hurdle, or what do I need to do to be able to grow into my market price type analysis, which I personally find interesting and helpful, and hopefully you do as well. And the question, and this, you're better equipped to answer this question than I am, given the increasing competition in the space, is that going to happen? Can they squeeze out $10 if they were to keep all their 54 million members in post-tax income? Or can they go acquire new members? Or can they cut costs? So one way to stress test the story is to, again, look at so-called momentum. So I went and looked at the 3 quarters that have elapsed since the annual numbers came out. So this is some data from the third quarter 10Q, which is the quarterly report. So they've managed to increase members from 53.6 to 57.8 million members. That's interesting. So the rate of growth is roughly around 4 million members in the first 9 months. Prices, however, are a problem. So they've managed to squeeze out $2.60 as opposed to $2.32. So what does that mean? 28-cent increase, which is not bad, but it's still getting harder. So you're kind of hitting your resistance points in some sense in the market. So they managed to squeeze 28 cents out of every member. Visit revenue seems to have fallen, but since I don't have a good handle on visits, I'm not going to spend too much time worrying about that. The one thing that did bother me, look at ad spending. Ad spending went up by 170 mil for incremental revenue of 290 mil. What does that mean? I'm basically spending 50 cents to make $1 in revenue. You could always argue there's a lifetime value to the customer, et cetera, and I buy all that, but this is still a bit disturbing. When your revenue goes up by $1 and your ad costs to attract that revenue went up by half of that number. Steady state fixed costs again seem to have gone up. Initially, we'd come up with a 1.4 number. It's probably closer to like 1.7. And again, this notion of, are we scaling? Where is this so-called tipping point? It's kind of worth asking ourselves over and over again. And I know I'm running out of time. I'll just make one more point and let you be. Stock options. So this is a industry, as you know, where companies are fairly generous in giving out equity. But some of the numbers that I saw were interesting and somewhat worrisome. This share count has more than doubled. So as of 12/21, they had about 71 million shares. As of the end of third quarter 22, roughly 160 million shares. A lot of it, granted, was used for acquisitions. They bought the Livongo and so on, mostly through equity, 64 million shares. They have a whole bunch of convertible debt on their balance sheet, which makes enormous sense because you're sharing risk with the others. If the option is in the money, people convert, otherwise they don't, that's okay. That's around 10 million shares. But look at employees. They've given away roughly 4.5 million shares and 12 million more outstanding. So that's roughly 7.5% of the company. So that's something else to keep an eye on. And the accounting system in general undercounts the share compensation that gets given out. And sadly, it's the elementary law of economics. People don't value free. If you undercount something, they overuse that resource. And this is one more application of that is the share-based compensation idea. So bottom line, I've dragged you through a lot of numbers after lunch in 15 minutes. So is it worth worrying about all this? And I would say yes, regardless of who you are. Whether you're an investor, a CEO, or a board member, it's pretty important to worry about financial sustainability and at least make sure that the big picture story hangs together, makes sense. If something is too good to be true or too bad to be real, at least ask some hard questions. So that's all I had. I can go on and on, but thank you.
Thank you, sir. Well done. Again, another viewpoint and point of view from outside of healthcare to better understand what's happening inside healthcare and what we need to do as an ecosystem to improve healthcare through digital.